Many people are paying more taxes than they need to pay. We're going to explore how Roth IRAs can work to avoid taxes, and another strategy to consider when a Roth IRA is not the best first option for your savings. Let's go. A Roth IRA is an account which accepts contributions that are not tax deductible and then allows tax-free growth for the entire life of the plan. Yes, I did say tax-free. This means an investment in a Roth IRA could return 1,000% or more, and you would never have to pay income taxes on the growth again, even when you withdraw the money. Roth IRAs were born in 1997 through the Taxpayer Relief Act, co-sponsored by Senator William Roth of Delaware and Senator Bob Packwood of Oregon. They designed the plan to avoid budgeting rules in Congress and give people a long-term tax break without feeling the cost in government budgeting for at least 10 years. This background has encouraged many people to consider the Roth IRA an important tax loophole. The major limitations of a Roth IRA have to do with the low contribution limits and how to get money out of the plan if you need it before age 59 and a half. Take a look. For the year 2021, contribution limits for a Roth IRA are only $6,000 a year or $7,000 a year for people age 50 and older. If you're a single filer, you can make up to $125,000 modified adjusted gross income, or MAGI, okay, and still contribute the $6,000 a year. At $125,000 MAGI, income, modified adjusted gross income, the Roth contribution limit begins to decrease or phase out. And over $140,000, you can no longer contribute to a Roth IRA. Now, modified adjusted gross income is basically adjusted gross income plus adding back some of the deductions, things like IRA contributions, taxable Social Security payments, losses from a partnership, passive income losses, rental losses, and some of those things. Now, with a traditional IRA, there are also income limits that affect tax-deductible contributions. And, of course, the government will get a bigger scoop of your profits in the end, too. Here are some key differences between a traditional and a Roth IRA. Traditional IRA, you have tax-deductible contributions. That's a nice plus. You don't have that with a Roth IRA. But all the other things with a Roth IRA are good things. You don't have to take required minimum distributions after age 72. You have tax-free withdrawals and tax and penalty-free withdrawals of contributions after 5 years are allowed with a Roth. It's not so much with a traditional IRA. You would still have to pay the taxes, and you would have to wait till 59 and a half to even get back your contributions in a traditional IRA. Now, continuing with contribution limits for a Roth IRA, if you are married filing jointly, you can make up to $198,000 modified adjusted gross income per year and still contribute the $6,000 a year. $198,000 to $208,000, that contribution limit begins to phase out, and at $208,000, you can no longer contribute to a Roth IRA. Now, if you're married filing separately, these limits are significantly worse. Contribution limit is always phased out up to some degree, up to $10,000 a year. And at $10,000 modified adjusted gross income and above, you can no longer contribute to a Roth IRA. Now, to get around these low contribution limits, people will often convert assets from a 401k or some other traditional retirement plan to a Roth IRA, paying the taxes in the process. This can be called a Roth conversion, a rollover, or a backdoor Roth IRA. Now, since a conversion avoids contribution limits, you can get a lot of money into a Roth IRA very quickly with this strategy, regardless of your income level. When the investments you wish to make are available in a Roth account, this strategy can work quite well. Many prominent entrepreneurs, such as Max Levchin and Peter Thiel, co-founders of PayPal, have accumulated multi-millions tax-free in Roth IRAs through backdoor conversions, even though their income is too high to contribute to a Roth IRA with standard contributions. There is a catch, of course. Unless you're over 59 and a half, you have to wait 5 years to withdraw money after a Roth conversion. Otherwise, you'll face a penalty. Most people who choose to make a Roth conversion do not want to withdraw any money from the new plan for several years. It's also worth noting here that until recently, there was a loophole which allowed people to pass Roth IRA accounts income tax-free from generation to generation. No more. This loophole has been closed by the Secure Act of 2019, which requires distribution of all inherited IRAs within 10 years of the death of the original account holder. Now, once you have money in a Roth IRA, you always want it to grow because the growth is tax-free. Now, of course, you would like to earn 1,000% or more, but the challenge is finding the investments to make such a great return. Earnings in a Roth IRA depend on how much you invest, what investments you make with the plan, and how those investments work out, minus any management fees. That gives you your net growth. Now, as with any investment, it is possible to lose money in a Roth IRA because the performance of the account is based on the performance of the underlying investments. Most people invest their Roth accounts in mainstream investments such as stocks, bonds, and mutual funds. So the most commonly acknowledged cause of losing money is because of market fluctuations and the timing of those underlying investments. Management fees can sometimes be paid with other funds outside of the plan, but not always. Losses from fees charged within a plan can be huge over a lifetime, even though the fees seem really small at the time. For example, a $100,000 Roth IRA account growing, let's say it's earning 5% each year, that could grow to over $432,000 over 30 years. But with a 1% management fee that's taken out of the account each year, you'll end up with only $319,000 and a few extra dollars in the account after 30 years. This is a loss of $112,000, even though you only paid $58,400 in fees. Management fees are more subtle than investment losses, but they're an important factor to consider. If you're looking to invest through a Roth IRA, the first step is to see if your income allows you to contribute to a Roth. This is an easy question for your CPA to answer. You can also consider what options you may have available for a rollover from another retirement plan to a Roth IRA. If you're starting a Roth IRA through a rollover, you should consider ahead of time whether you will do a direct or indirect rollover and what your tax liability will be. Next, you select a financial institution to open the Roth IRA. This company is also known as the IRA custodian. Ideally, you want to choose a custodian with a low management fee and which offers the investment options you want. Finally, filling out the paperwork to open a Roth account is easy. Usually a social security number, driver's license, employer, and bank information will be required, and you will also set a beneficiary at the time of opening a Roth account. So, is it worth following all the rules to invest through a Roth IRA? You'll need to give up access to your contributions for at least 5 years and also give up access to your earnings on those contributions for 5 years or until age 59 and a half, whichever is longer, to avoid the 10% penalty. There's also the expense of an annual management fee to the custodian plus any fees on the underlying investments. And finally, lost opportunity. It's a short name, but it's probably the biggest downside of a Roth IRA because access to your money is restricted, and so are the investments you can make within the plan. Investments in your business or even a real estate investment where you would make a do-it-yourself improvements. Those type of investments are off limits within your Roth IRA. Now, obviously, Roth IRAs are not the only investment options. There are a wide variety of retirement plans to choose from, or you can choose to bypass the restrictions inherent with all retirement plans and make your investments directly without tax-deferred benefits. Many people are not good candidates for saving through retirement plans. If you don't want to take risk investing in the market until you build a strong financial foundation, retirement plan's probably not for you. If you want to invest in your own business or a closely held family business, not for you. If you want to keep access to your money to be able to self-finance major expenses or special investment opportunities, which could arise outside of a retirement plan during your lifetime, they're not going to be for you. And of course, some people, they already max out their Roth contribution limits, or maybe their income is too high to contribute to a Roth at all. These people need to look beyond most retirement plans. So what's a good alternative? Certain types of participating whole life insurance can be structured to provide a high level of security and guarantees with many of the benefits of a Roth IRA, but no contribution limits and no limits on accessing your money. Premiums are not tax deductible, they're taxable, okay, but the cash values do grow, tax deferred, and the death benefit is ultimately income tax free. In these respects, life insurance is very much like a Roth IRA account. Accessing the cash value in a life insurance policy is easy. Cash values can be leveraged via policy loan within the first year of a policy, usually to about 60% of the initial premium amount. By year 4 to 5, cash values can grow by more than the premium each year. And the cash value in the plan is always accessible by policy loan. Policy loans can be used for any purpose, and there are no limits on the types of investments you can make. You can fund a real estate investment with a policy loan, even if you plan to put sweat equity into the property. The catch here is that the return of most investments funded through a policy loan will be taxable. But as long as the return is more than the policy loan interest, this can obviously be productive over time. Many people find it makes sense to use whole life insurance to build their financial foundation first. And if they still want 100% tax-free growth on some investments through a Roth IRA, then they can add the Roth IRA later, once they have strong liquidity through life insurance. There's a capitalization phase for a whole life insurance policy because it takes 8 to 15 years to recover all of the premiums paid. But from the very beginning, policyholders have a death benefit protection which works out to be less costly than buying term insurance over a long period of time. In retirement, tax-free withdrawals can be made from a whole life insurance policy up to cost basis, which is the total premiums paid, or the entire cash value of the policy, which will usually be more than premiums paid by this time, can be leveraged through an interest-only policy loan with no taxes. Now, withdrawals beyond the premiums paid would be taxable, but there are other options for passive income that involve life insurance which are usually better than a straight withdrawal and policy loans. Now, if passive income is not needed from a whole life policy in retirement, then the death benefit goes income tax-free to your heirs. And this helps make whole life insurance a great tool for building generational wealth. At Life Benefits, we specialize in designing whole life insurance to maximize the cash value and living benefits. Call our office at 702-660-7000 to see what a well-designed whole life insurance policy can look like for you.